Welcome back, Dividend investors. Today I want to preface the video by saying we are going to talk about a trash company because we are indeed going to talk about Waste Management, stock ticker WM. Yesterday they actually announced they declare a 70-cent dividend in line with previous. Roughly 1 month ago they released the earnings call, which was a slight miss both on the top and the bottom line. Year to date they are up 1.17%, so roughly trading sideways, and if we zoom out a little bit over 1 year they are down roughly 9%. It is a pretty strong company, defensive business model, high recurring revenue, and a healthy balance sheet. And they have also outperformed the S&P 500. So if we look here, as you can see, we do have Waste Management in orange and S&P 500 in blue. And as you can see here, they actually have outperformed over the last 5 years. As mentioned, they just announced their latest dividend, and it is a forward yield of 1.76%. Payout ratio below 50%, very healthy. 5-year growth rate of between 8 to 9%. Dividend growth rate is just 3%. And if we look at 3 years, and if we look into the dividend history here, you can see that it actually have paid for several years longer, actually 21 years, but the dividend growth was stopped back in a couple of years ago, and now it has increased ever slightly again for the last 3 years. As mentioned, they have a very strong balance sheet. You can also see here the revenue is increasing pretty well. We can see roughly 15 million 5 years ago, up to around 20 million this year. So roughly adding 1 billion each year. If you come down to the net income, you can also see here that they have managed to increase it a little bit from 1.9 up to 2.2%. It is an industrial, so there are some capex for this company to be able to run, obviously. Also jumping into the cash flow statement, we obviously want to see them generate some free cash flow to be able to grow that dividend in the future. You can see cash from operations started at 3.5 billion and now are up to around 4.3, 4.5 in that area. So adding 1 billion in cash from operation over the last 5 years. Capital expenditures have also grown though from 1.7 up to around 2.5, 2.8. So indeed, they are also needing to use more money to actually earn that more money. But if you come down here to the bottom, you can see here the free cash flow per share. It actually has declined a little bit. You can see 4.37 up to 4.72, but then it drops a little bit. And that is because they have used a lot of cash to expand. So in the future, I wouldn't worry too much about this. I think this is very transitory because they are expanding the business. So this will grow in the future back to a pretty healthy free cash flow per share, and thus also opening up for dividend increases and more expenditure expansion and so on. So really looking very good so far. And if you want to take a look at what the Wall Street analysts are thinking, they actually have it as a slight buy between buy and hold, as you can see over here. And that is because if we look at the analyst breakdown on the right, you do have 7 with strong buy, 2 with a buy, 11 with a hold, and only 1 on the sell side. Coming down here, you can see the price target average is around 12% upside from the current level, with the average price target being $177. And also pretty quickly taking a closer look at the price target versus actual price, you can see here a couple of weeks ago, we were pretty close to the price target, but then it dipped a little bit. So in this video, we want to take a close look at the intrinsic value, obviously, to take a look whether or not it could be a potential buy at the current levels. So jumping into a stock screener here and wait for everything to auto-populate, you can see ever so slightly things starts to move in. So let's see, we do have the EPS growth over the last 5 years sits at 7%. Really nice to see. PE ratio forward is around 24, which is a bit below the 5-year average. It's an extremely high multiple, but again, as mentioned, it's an extremely well-run company. So people are willing to pay a bit of a premium for Waste Management. We are a bit in between the 52-week high and low. The revenue, as mentioned, is CAGR annual growth rate of 5% roughly. There's a bit of a little red flag, and it's mainly more like an orange flag here. The net debt to EBITDA, as you can see here, is 2.7. So a bit high for my taste, but again, it's a minor thing, to be honest. Return on invested capital and return on equity sits right around the 5-year average. I think it looks pretty good around the 12. Return on equity, 32%, which is above the 5-year average. Also extremely well run, I believe. Gross margin at 48%. Operating margin, it is negative at the current moment. Just want to double check that. Of course, you can see here the 5-year average sits around 17%. So might have to do something with the expansion as mentioned earlier. Profit margin sits at 11%, which is pretty good to see. You can see the operating margin has declined a little bit, but you might want to take a look at it closer to be able to see if it's something that is transitory or if it is indeed a flaw in the business model. We also want to take a close look at some of the dividend data, and if you zoom in a little bit here, you can see everything a little bit better. You can see the 10-year growth rate of the dividend sits just shy of 7%. We saw earlier the 5-year growth rate was just around between 8 and 9, looking really good. So what we want to see here is some steady growth. You can see here it sits pretty nicely. We do have a one small here, but then it's around 9, 10, 6, 5, and so on, and then 13. So they are growing the dividend pretty steadily, I would say. And if you come down here to the dividend yield theory graphs, you can see here, dividend yield sits roughly at the center right here. So could indicate that at the current time, it is trading around a fair value. But to determine the intrinsic value, we do have a lot of valuation models. So let's jump right into them and take a closer look. First one being the discounted cash flow model, where we do take the free cash flow from the different years. We then apply a growth rate for future free cash flows, discount them back to a present value. We can then calculate a fair value based on that. Next one is a dividend discount model, where we take the dividend payout from the different years. We then calculate using an average growth rate from the dividend and the weighted average cost of capital. We can calculate an intrinsic value. In this case, they do have a very high growth rate, so the intrinsic value gets pumped up a little bit too much. We also have the multiples of valuation, where we do take some comparable companies and the PE of those companies. We can then calculate a stock price based on those medians and the current EPS of Waste Management. Next up is the Graham's revised valuation model, where we do take the EPS, the growth rate from the company, the PE of a noteworthy company, average yield of AAA corporate bonds, and the current yield of AAA corporate bonds, combining all those using Graham's formula to get an intrinsic value. We also have the PE, price to earnings valuation, where we take the price to earning ratio, average that, combining with the EPS to get an intrinsic value. Same here, we do have the free cash flow valuation, where we take the price to free cash flow ratio and then do the same thing as before to get an intrinsic value out of that. The last one is the Peter-Lynch model, where we do take the growth rate, the dividend yield, the PE ratio from Waste Management, combining all that together to calculate an intrinsic value based on the Peter-Lynch formula. Before we jump into the summary, thank you so much for watching, and if you haven't done so already, please subscribe to the channel. Now let's jump into the summary and take a closer look at the different valuation methods we had for Waste Management. You can see here we do have everything, and I think it's fair enough to exclude all of them because you can see some are a bit below and some are a bit high. So obviously those areas together is why we have so many different methods. You can see the average intrinsic value is 196%. With the current price being 158, it could indicate an average current discount of 19%. We also obviously want to apply a margin of safety, and that is why we do have our margin of safety calculator over here on the right. So what we do is that we start with 25, depending on some of the key metrics such as EPS growth, return on invested capital, and so on. We do either subtract or add some margin of safety. In this case, we subtract 20 based on some of the key metrics, as you can see here. Adding that margin of safety of 5% over here, we do arrive at an acceptable buy price of $186. Pretty close to the analyst target price of the 180. So obviously there are some estimations based here. So obviously it will never hit 100% the same. But I do believe if you want to go into this company, I believe it's a fair value right now, as we also saw based on the PE and the dividend yield theory graphs. I think it's a very strong company and it's definitely something I would like to have in my portfolio. So I will definitely take a closer look just based off this, because at the current time, it could indicate actually that the levels right now are pretty nice to go in the company. As Warren Buffett famously said, it's much better to buy a wonderful company at a fair price than a fair company at a wonderful price. And I do believe that this is a fair price. Thank you so much for watching, and I'll be seeing you in the next video.